This video is brought to you by BlockFi. Get up to $250 totally for free when you invest cryptocurrency at BlockFi. Go to metkevin.com/BF to get up to $250 totally for free when you deposit money with BlockFi. They pay you interest on your cryptocurrency, and they're a great app for building your wealth with cryptocurrencies. And you can actually transfer your cryptocurrency as well. metkevin.com/BF. Hey everyone, me Kevin here. A lot of folks are very interested in understanding the short squeeze for AMC, and out of our research for the short squeeze for AMC comes a lot of terminology, including naked shorting, synthetic shorting, puts versus calls. Folks, it can be overwhelming. So in this video, I want to give you a Monday, June 7th update on exactly what the latest short information is and what the trends are for AMC. We're not only going to look at the short interest data, but we're actually going to look at some put-call ratios and explain some other topics as well. But first, I want to give an explanation of what the different methods are for shorting a stock. So first things first, we know that you can short a stock by borrowing it and then selling it, and then in the future repaying it. This is very simple. We don't need to go super deep in this. You could just picture this very simply. If AMC is, let's say, $100 today, and you have a bunch of AMC shares, I go to you and I go, hey, you mind if I borrow your AMC shares? Like, I'll pay you 10% interest or 50% interest, just depends on what the market prevailing rate is. To keep things simple, let's just say 10% interest. I'll pay you 10%, let me borrow those shares that you have for a while. So I'll borrow 1,000 shares from you. And then I'll take those $100 shares, and if I want to short them, I just instantly sell them. That obviously puts downward pressure on the market because there's more selling activity. A hodler is getting paid interest and is getting promised that that person is getting their shares back. But in the meantime, rather than that person hodling, somebody's borrowing them and dumping them onto the market. Obviously, that pushes prices down. That's the nature of short selling. And the argument for a short seller is, hey, if I can take a $100 stock and short it all the way down to say $30, and then I'll just buy it back at $30. Now I'll give those same shares back to the person I borrowed them from. They're worth less, but I'm giving them the shares back, that same 1,000 shares back I borrowed. Perfect. I profit $70 times the 1,000 shares, so 70 grand. That's just basically short selling, minus the fact that now I have to pay interest, right? Okay, we know that. That's very, very basic, but it gets a little more interesting. See, that's basic short selling. Now let's talk about naked short selling, which is another type of short selling, which is oftentimes considered to be illegal, but there are a ton of loopholes, which basically mean it's not really illegal. Take a look at this. So this is a report from Stanford, and here it indicates the SEC, being the commission. In 2009, the commission adopted a rule which requires that fails to deliver in all equity securities be promptly closed out. Failed to delivers, among other things, may be indicative of potentially abusive naked short selling. So basically how this works is you call up your broker, just to make this simple, and go, yo, Fidelity, hit up my account right now for 1 million shorts on AMC right now, please. Thank you very much. Okay, just charge my account the interest. Thank you, bye. And the broker has a responsibility to make sure they can actually get 1 million shares to sell. So they have to borrow those shares from somewhere, they have to identify those shares, and they have to sell them. But sometimes that takes 2 or 3 days. And if after 2 or 3 days that person was essentially shorting the stock, but in settlement time, the stock never existed, technically that person still gets a gain for shorting the stock, and the brokerage failed to deliver those shares, which is a big problem. This is like an interest-free way of manipulating and gaming the system. And so that's why we have this here. Naked shorting, which is not illegal per se, occurs when a short seller does not borrow the securities in time to make a delivery. This is the brokerage, does not borrow the securities. Sellers may intentionally fail to deliver as part of a scheme to manipulate the prices. And so that's when it becomes illegal, is when brokerages are not doing this by mistake, but they're on purpose, like, yeah, let's do that. Let's short, and let's fail to deliver them. And this is a way to essentially avoid those high borrowing costs, which borrowing costs are pretty high on, for example, AMC right now. Data indicates that since the fall of 2008, fails to deliver have declined, blah, 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 blah. Okay, great. But a lot of folks believe that naked short selling is illegal. But the SEC actually has a document specifically on this. In a naked short sale, the seller does not borrow or arrange to borrow the securities in time to make delivery to buyer within the standard 3-day settlement, the brokerage. As a result, the seller fails to deliver securities to the buyer when delivery is known as failure to deliver, or fail. Failures to deliver may result from either a short or long sale. There may be legitimate reasons for a failure to deliver, for example, human errors or mechanical errors. Sure. A fail to deliver may also be the result of a naked short sale. For example, market makers who sell short, thinly traded illiquid stocks in response to customer demand may encounter difficulty in obtaining securities when the time for delivery arrives. So this is really a loophole for the brokerages to say, hey, look, our customer called us and said they wanted to short a bunch of AMC stock. We want to take care of this customer, so we enabled their short sale, but then we realized the stock was really illiquid. There weren't shares available to be borrowed. The share utilization was near 100%, like it has been for AMC until today. Now it's at about 90% utilization, so there are more shares available for shorting, and boom, you have a naked. Now, people say this is illegal, but folks, literally, if you go to the SEC.gov, it literally says right here, naked short selling is not necessarily a violation of the federal security laws or commission rules. Indeed, in certain circumstances, naked or short selling contributes to market liquidity. They're basically saying, like this, it's almost like the SEC is... I don't want to draw judgments, okay? You draw your own judgments here. But you can see when you actually look into it a little bit in more detail. Like, for example, look, and this is why I make videos, and this is why hopefully you give me a subscribe. If you just type in naked shorting into Google and you go to Investopedia, it says, naked shorting is the illegal practice of short selling. Well, apparently it's not, given that the SEC literally says it's not. And they talk about how there are actually cases where naked short selling is good. For example, broker-dealers that make a market in a security generally stand ready to buy and sell security on hand for a regular basis, blah, 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 blah. This may occur, this may occur, for example, if there is a sudden surge in buying interest, like in AMC, or if few investors are selling the security at the time, a lot of hodlers, because it may take time for the market maker, or may take a considerable amount of time for the market maker to purchase or arrange to borrow security. A market maker engaged in bona fide market making, particularly in a fast-moving market, may need to sell the security short without having arranged to borrow the shares. This is especially true for market makers in thinly traded illiquid stocks, as there may be few shares available to purchase or borrow at a time. Bingo. So you can take this out. It's literally key points on regulation SHO, and it is under the what is a short sell definition tab of the SEC's website. So, okay. Yeah, naked short selling happens. Now, the cool thing is, well, it's not really so cool because the SEC is like super slow on it, but the SEC does give you data on how many fail to delivers there are. This is a chart of the fail to delivers for AMC. Unfortunately, it takes about a month for us to get this data. And so over here on May 10th, for example, so it goes to May. On May 10th, for example, we could see that 3.6 million shares failed to deliver for AMC. But if we go to Webull on May 10th, so let's go to AMC, we're gonna go to the day chart, and we're gonna go out to May 10th, which is right here. We're gonna see that there was volume of 38 million shares. So that's actually a sizable portion. That means literally on May 10th, almost 10% of the shares that traded that day failed to deliver. That's some serious naked short selling right there, right? That's an issue. Unfortunately, we don't get that data in more recent times or close to when we have these sort of market movements because the SEC has a 30-day, sort of time frame to give us that failure to deliver data or fail to deliver data, which is pretty freaking annoying. But anyway, that's naked short selling. So you have regular short selling and then naked short selling. Then you have synthetic shorting. This is basically done with options. So remember, if you want to make money in a stock, you could buy the stock or by buying shares, or you could buy a call option. A call option is not actually buying shares of the company. A call option is just you having a contract giving you the right to buy shares at some point in the future. And the value of that contract, which is derived off of the value of the share price, hence derivative, that value fluctuates, oftentimes much more than the value of the shares fluctuate. You get much more fluctuation in options. This makes sense. So you buy that derivative or a call when you want to make money as the stock goes up. But if you want to make money as the stock goes down, you buy a put. That's when you start making money as the share price goes down. Okay, great. So what is a synthetic short? Well, a synthetic long is buying calls. A synthetic short is buying puts. And if you want to do a solid synthetic put strategy or a synthetic short strategy, what you can actually do is you can sell at the money calls and you can buy at the money puts. So let's say AMC is at $60 right now. This strategy says that you agree to deliver shares of AMC to somebody at $60 with your sold call if the share price is more than $60. So you take potential unlimited risk that way, and you make money if the share price goes below $60. This is considered a synthetic short because you're making money when the price of the stock or the share price goes down, and you have unlimited risk because you've sold at the money calls, which you can do naked, which means you don't actually own the shares. So if AMC goes to $400 and your call comes to expiration and you have to provide those shares, you have to potentially provide an unlimited amount of shares to fulfill that call option at $60 for someone else, right? This is a synthetic short. That does not show up in short interest data because it has nothing to do with the shares. We know that short interest data is just a way of determining, hey, how much as a percentage of the shares that are trading on the market right now, as a percentage of float, how much of those or what percentage of those are actually short? And that's pretty easy. I mean, you could use Ortex for that. You could use the Bloomberg terminal for that. There are plenty of tools to determine what the short interest is of something. For example, here's the S3 Partners. It says that right now we're at 14.91% short as a percentage of float. So that's the short interest. But these synthetic shorts, the options I just talked about, those don't actually show up in the short interest calculation. Then there's yet another way that you could short. And this has to do with total return swaps. And then we're going to get to a bottom line here. So total return swaps, this is when you essentially deal with something known as a synthetic prime brokerage. It's synthetic prime brokerage trading. And so here's the way this works. Let's say you want to short AMC. You think AMC is going to go down. Instead of borrowing the shares and then dumping them, you get a total return swap where you're paid an interest rate for agreeing to compensate the brokerage if AMC goes up. So let's say AMC is at $60 and you think it's going to go down. Well, you could go to a brokerage and say, hey, I'll pay you whatever AMC goes up. So if AMC goes to 100, I'll pay you that $40. But I don't think it's going to go to 100. I think it's going to go down. So I want you to pay me an interest rate. I want you to pay me 10% or whatever, and I'll compensate you if it goes up. If it goes down, hey, I don't have to compensate you anything, and I get paid the interest rate. That's another way to bet against AMC. And guess what happens in this example? If you set this up, the brokerage is like, great, we're paying this interest rate, but what if AMC goes down? We need a hedge to make sure we don't lose money in the event AMC goes down. So guess what the brokerage does? It shorts the stock. So if it shorts the stock and the stock goes down, it doesn't lose all of its money paying all this interest. Now, this could potentially contribute to naked shorting. So this is how you get this cluster of this combination of all these different ways that you can combine shorting a stock. So you have regular shorting, which is you borrow the shares and you dump it. You have naked shorting, which technically isn't illegal, but it just happens in sort of illiquidity events. But that naked shorting can dampen the ability for a stock to actually run when it should. It just tends to happen shorter term. Like brokerages try to clear those out ASAP. Otherwise, they're going to get in trouble by the SEC. So regular shorting, naked shorting. Synthetic shorting is options. And then you have swaps. Now we can measure, we've seen the things we can measure so far are we can measure how many shares are available to borrow. This helps us, and we've seen that more shares have become available to borrow. So there's actually more liquidity at AMC as of June 7th right now. We've gone from 99% utilization to like 89 to 90% utilization. So more shares are available to borrow. In addition to that, the short interest on AMC is actually going down. Last week we were at 20 to 18%. Now we're at 14%. So you've got share availability is up, which means probably less naked shorting because shares are available to be borrowed. So you don't have as many issues locating shares to borrow. You have short interest that's down, and you can look at synthetics by looking at the put-call ratio. And what we're seeing over here is you do have an elevated level of buying puts. So this is the put-call ratio is basically just you divide the amount of puts there are by the amount of calls there are outstanding at any given time. This is a chart from today, and it tells us that right now we're at an elevated, we're more puts than we are at calls, which the break-even point's obviously 0.5. It's the put-to-call ratio. So we have more puts than calls right now, but we're not really seeing this skyrocket, kind of like we did in early March or in January. This is when we really had a lot of put pressure, or a lot of put pressure over here, sort of in mid-March. These are times where people are really setting up those longer-term put positions. Right now, we're not really seeing that spike, and this is today's date in the put-call ratio here. So, all right, bottom line, what are we seeing? Well, now we understand a lot more about the different kinds of shorts that exist. If you like this content, obviously make sure to subscribe. But so far, we are seeing a little bit of a trend down in the amount of shorting that's happening. We're not seeing the massive spikes that we saw in January and March for put volume. We're not seeing that same massive spiking in short interest data as we are, or what we saw in even January or earlier. Because, for example, here, I could show you this. We could go back year to date on the short interest chart. And now I'm getting a little, there we go. You could see we're not at all-time lows. We have gone down to about 10.88% here, but we're definitely lower than where we have been. So does that mean the squeeze is getting squoze? Is today the day we start seeing that transition where the squeeze is getting squoze? Or is this just the beginning? I don't know, and quite frankly, it doesn't matter to me because I'm hodling over $75,000 of AMC shares, and I don't really care. If it goes down, I might buy more. In fact, I will buy more if it gets down to a certain level. If it goes up, great. But I'm hodling for at least a year, as I promised. This just gives you some more insight into some of the trends that I see happening in the market right now. And if you found this helpful, make sure to subscribe. Thank you very much for watching, and folks, we'll see you in the next one.